welcome to Business on the Wire. Economic indicators that picked up in June are beginning to flatten out again. What might the road be for India's economic recovery? What might the role of the central bank be? And what about the concerns that have now been raised by several former RBI heads about the Reserve Bank diluting norms, perhaps at the cost of the economy and, of course, fiscal stress? Joining me to talk about all of that is former Reserve Bank Governor Mr. D Subbarao. Thank you, Mr. Subbarao, for joining in and speaking with me. Things have been a bit bumpy in terms of Indian economic activity. What looked like a recovery in June is beginning to flatten out again in July. How are you reading this concept of green shoots versus not quite yet?
Well, the economic situation seems to be quite grim. Both the short term and the medium term prospects are quite disturbing. People have talked about 75 to 80% recovery, but that's not saying much indeed, because we're talking about a mechanical rebound from a very low base of the total lockdown period of March and April. Even if indeed we get back to normal 100%, that is not saying much, because you must remember that when we entered the crisis, our economy was quite weak. We grew at 4% last year. So even returning to normal is not saying very much, because we'll be returning to a low base. And this crisis has been very uncertain. There have been far too many known unknowns, like, for example, about the when there might be herd immunity, when there might be a cure, when there might be a vaccine. There are far too many known unknowns. Meanwhile, the virus is spreading. The number of daily cases is growing. The doubling time is coming down. The virus is spreading to new areas. So as long as the health situation continues to deteriorate and the health crisis continues to rage, the economic uncertainty will continue to be accentuated. So I think the situation is quite grim.
I want to refer, sir, to a note by the global forecasting firm Oxford Economics that points out that India's GDP is possibly going to lag again starting the third quarter. But they go on to say that India fares the worst in Asia in the recovery scorecard and will probably take the longest amongst major economies to converge to its pre-coronavirus growth level. Now, as you pointed out, not only is that not something to aspire for, even if we get to 100% growth, we've probably created a large wedge between us and several other nations in terms of this growth trajectory.
Well, that's absolutely correct. I agree with that assessment, because we're a large economy and we're the third most affected country by the pandemic in the world. So if Oxford Economics says that we will take much longer to get back to our pre-growth level, which itself is not high, I think I agree with that assessment. We must remember that, as I said earlier, our economy was quite weak as we entered the crisis. Last year, we clocked growth of 4%. Here, there's going to be a contraction of at least 4%. So from plus 4% last year to negative 4% this year, there's a contraction of at least 8 percentage points in growth. Our fiscal was quite overstretched even before the crisis. It's going to be even more overstretched now. Our financial sector was in deep stress and is going to be in deeper stress now as a consequence of this. So I believe the economic situation is quite uncertain. It will take a very long time, especially because of the financial sector stress, which is going to get even worse. So yes, it might get worse before it gets better.
I want to take on that point of financial sector stress, Mr. Subbarao, because it's been in the news, courtesy two books that have been released both by a former Reserve Bank governor and a deputy governor, where they go on to say, at least Dr. Acharya does, that the RBI is diluting some of the toughest measures prescribed for financial stability. And perhaps that is the fear that post the lockdown, the wreckage in terms of bad loans for the MSME space or the corporate space are going to be far larger. How would you address that concern, sir? And are you of the same thought?
Well, I've not seen Dr. Acharya's full book, but I know that it's a collection of speeches. I can relate to what he said. But having said that, we must recognize that this has been a very unusual crisis. It's not a usual financial crisis where the central bank is right in the forefront and has some understanding of where it's going. But this is a crisis caused by a cause outside the financial system, outside the economic system, and the Reserve Bank is reacting to that. The Reserve Bank has cut rates, infused an enormous amount of liquidity, and has indeed undertaken many unconventional monetary policies. And I believe in two objectives. The first objective is to preserve financial stability, and the second objective is to encourage banks to lend to productive units. I believe it's been quite successful in the first objective of maintaining financial stability, and not so successful in encouraging banks to lend because of the risk aversion that's already there. But going forward, we must acknowledge that this is a situation where monetary policy has space but no traction. Fiscal policy has traction but no space. So RBI has done enough, but I think they must keep their powder dry because we do not know how this pandemic will unfold in the months ahead and what impact that will have on the economic situation.
I want to take you up, sir, on that specific point about the Reserve Bank and its unconventional measures, because some economists now point out that unconventional has become the new conventional. And perhaps one challenge for central banks across the world will be that an exit from this kind of a situation will be very difficult.
Oh, yes, indeed. Exit from crisis-driven policies is difficult at any time. But exiting is very difficult because there's a lot of deliberation that goes into it. That's been true of central banks around the world. That has just been true of the Reserve Bank of India during all the crises that we faced in the last 10 years, including the global financial crisis when I was the governor. And that will be the case even now. The Reserve Bank has got into an extraordinary liquidity position. They've cut rates, but they've got to be quite deliberative as they exit from this, because an early exit can unnerve the markets. On the other hand, a delayed exit can exacerbate problems. So timing and action and the communication of that action are going to be very important in the exit phase.
There is another fear, Mr. Subbarao, that perhaps given the dramatic increase in terms of debt holding by the Reserve Bank, there is now a blurred distinction between governments and central banks, and that may go on to pose a sovereign threat. Is that something you concur with? Is the central bank sitting too close to the government?
Well, okay. In normal times, it is advisable and appropriate for the central bank to distance itself from the government, not only do that, but appear to do so. And that debate we've had around the world, we had in our country as well. But a crisis time is different. This is not the time for the government and the central bank to expose their differences. Markets which are already tested will get unnerved even more. So crisis time is a very special time, a time when governments and central banks must be working together and must be seen to be working together, because that will inspire confidence of the markets and confidence of the public. On the other hand, if there's any dissonance, it will not only erode the effectiveness of the policies, but it will create more fear than there need be.
Let me swing back to the point you made about the fiscal options at this point that our country has in front of it. There has been a lot of criticism, Mr. Subbarao, about how India has done very little, comparing it with governments like the UK, where it now seems that their spend is actually between 17 to 20% of their GDP. Could India have done more? Because you've not been, of that line of thought.
Well, first thing I want to say is that as much as we compare ourselves with other countries, we compare what we've done with other countries, we must also recognize that we tailor policies to our domestic situation, our opportunities and challenges. So as we discussed earlier, our fiscal situation is quite difficult, even as we enter the crisis, and it's even more difficult now. I No, I'm aware that the government has attracted a lot of criticism for its fiscal restraint, for the fact that the Atmanirbhar package, for all its hype, just contains about 1.8 percentage points of GDP of additional spending. A number of economists have faulted the government for its fiscal restraint. Their argument is that the government should be spending more. This is not the time to be reticent, because if the government does not spend more now, problems will only get worse. I have some sympathy for that view. The government should indeed be spending more because there are no other growth drivers. Growth comes from consumption, public and private, exports, and from investment. Okay. There is no private consumption now. Households have run down their savings. Even if you put money in their hands, they're unlikely to be spending. There is no investment and there's no exports because the global economy is in a contraction. So the government needs to spend, and government needs to spend in order to prevent problems from getting bigger. But I have two caveats. First, it cannot be an open-ended, opening the spigots, money spigots. Government has to set itself a limit so that it is transparent, accountable, and it will become efficient. And the second thing is that because the fiscal space is quite limited, there's got to be all the greater thought going into how efficiently the money must be spent, how to get the maximum bang for the buck. For example, there are several alternatives, several options for the government to spend, put money in the hands of vulnerable households, or restructure bad loans, or recapitalize banks. Now, I would say that putting money in the hands of vulnerable households, as much as that is necessary, may not be the best value for a limited amount of money, because households, as I said earlier, are unlikely to spend.
Yeah.
So if our fiscal space is limited, I would say spend that on helping production units and supporting them in restructuring accounts and in recapitalizing financial institutions.
Mm. You've been in a position where you steered the ship at the Reserve Bank, Mr. Subbarao. So you have an eagle-eye view, both in terms of how far to go or how far to see, and also what needs to be done. At this point, standing where we are, what is your great fear on the fiscal side? How deep do you think the damage might be for us, even in this context?
Well, I think the fiscal situation is quite disturbing. It was quite weak, even as we entered the crisis. The best way to understand the fiscal situation is to look at the debt to GDP ratio. The debt to GDP ratio was 70% before the crisis. Now, most economists say that the debt GDP ratio will go up as high as 85% and will continue to climb in the next 2 to 3 years beyond 90% of GDP. And after that, will only decline very, very slowly, and if at all, to about 80 to 85%. On the other hand, we have the FRBM Review Committee, which said that an optimal debt to GDP ratio for sustainable growth in India is 60%. World Bank research shows that for an emerging economy, every percentage point of debt above 60% means a loss of growth of 0.02% every year. That might look like it is small, but cumulatively it can mean an enormous loss of welfare. So I believe the fiscal situation is quite disturbing, and the government, and indeed all the economists and analysts, must apply their mind to how the government can consolidate the fiscal situation once we get out of this crisis.
How then do you respond to the observations by the Chief Economic Advisor, Mr. Subbarao, where he says, we are safe on the fiscal front because our debt is largely domestic, even as other organizations like the ECB argue that keeping debt ratios at prudent levels is important to avoid a sovereign debt crisis?
Well, the Chief Economic Advisor was not the only one who said that. A lot of people say that India's fiscal situation is relatively safe, is that our debt is domestic. I believe that debt being domestic is a safeguard up to a point, but only up to a point. We know from textbook economics as well as from our own experience that fiscal excesses spill over into the external sector. The bruising balance of payments crisis in 1991, as well as the near crisis in 2013 in the wake of the taper tantrums, or a consequence of extended fiscal profligacy. So debt to GDP, debt being domestic is a safeguard, but cannot be a total safeguard. Okay, and people talk about Japan, that Japan's debt is domestic, but Japan is hardly a comparator. It enjoys an exorbitant privilege. So even if Japan's debt GDP is 150% or 200%, that's not comparable to our situation. America, yes, debt GDP can go higher because America issues the global reserve currency. We can't compare ourselves to them. And the final point I want to say is this, that our debt being domestic is no carte blanche about borrowing as much as we can, because all the other problems about high inflation, about crowding out the private sector, and denting our medium-term growth prospects, they'll continue to hurt us. So we've got to be extremely circumspect in our managing our fiscal.
I want to swivel back to the point you made about the Reserve Bank, Mr. Subbarao, and the fact that perhaps they had not been as successful in terms of ensuring liquidity was now moving within the system. They released their systemic risk survey, a few days back.
Financial stability report, yeah.
And many of those observations were quite worrying, frankly, especially for sectors like aviation, for tourism, for automobiles, where nothing has been done at this point in terms of direct fiscal relief. And it seems like they're not getting enough by way of liquidity relief either. How could the Reserve Bank have done this differently, sir?
Well, first, let's look at the Reserve Bank's financial stability report that you referred to, which was released earlier this week, which puts out quite a disturbing picture, quite disturbing because the Reserve Bank is, as I know, is quite conservative. The NPA ratio, which was about 8% at the end of March this year, they expect that to go to about 12.5% by March next year. And under a very stressed scenario, that's going to go up as high as 14.7%. And note this, that the assumptions underlying the Reserve Bank's very stressed scenario themselves are quite conservative. So if you apply what is the understanding today, widely shared understanding today of the economic situation, the NPAs are going to go beyond 15%. So I don't believe the Reserve Bank would have done much more towards financial stability or towards encouraging lending. Indeed, the bigger task lies ahead. What should the Reserve Bank and the government together be doing to provide support to loan accounts that are stressed because of the crisis, to financial institutions, including non-bank finance companies which are stressed? That's the task ahead. That's what the government and the Reserve Bank must be applying their mind to. And I'm sure that they are, just we don't know about it. Just because we don't know, we can't assume that. I'm sure that they're engaged in the task because there's going to be a lot of stressed assets. The economy is going to contract by about 4%, perhaps more. Production units, enterprises are not going to pay up. There are going to be many defaults. NPAs are going to rise. So they need support. At the same time, financial institutions are going to see higher delinquencies, and they need support too. And this is the problem for the government and the Reserve Bank to solve and resolve and address together.
This is a good point to segue into asking you whether you believe then, sir, this is a point where the idea of a bad bank makes sense.
Well, I have been quite disinclined towards a bad bank. I made several statements after I stepped down that a bad bank may not be the most efficient way of resolving bad loans, because I had faith that the IBC framework will streamline the resolution process. And the second question was this: where will the capital for a bad bank come from? If it's got to come from existing public sector banks, we're going to transfer we're going to have the same problem. Same disinclination, same timidity, same reluctance to bite the bullet. If it's got to come from the private sector, there'll be questions about political sensitivities. And if it's got to come from the government, my argument was that if the government is going to put in capital in a bad bank, it might as well put that capital in all the distributed banking system. But now gradually, I have come to the view that we must now try out a bad bank experiment. The reason being that NPAs are going to rise and the IBC framework is going to be overloaded. We cannot depend on that to streamline. Even in the best of circumstances, the IBC framework has to be the last resort. It cannot be a dump for resolving everything. And that becomes even more true today when the NPAs are going to rise. So a bad bank also has other standard advantages that the entity taking a decision on the price will be quite different from the entity that accepts that price. And it also has the other advantage that there will be efficiency in decision making. So there are several successful models of bad banks, like Malaysia's model they talk about, Anaharta, I believe it's called. So I think it's something worth trying now.
How would we address the concern of capital that you alluded to with this idea or experiment and so?
There are no free lunches. The problem of a capital is not going to run away because if you move from one structure to another. But of course, the government has tried recapitalization bonds. I know that recapitalization bonds are not perfectly elastic. You can't stretch them beyond a point. But I believe there is some space there still. And if it's indeed a public-private partnership, it will be even better. If it operates very transparently and is open to scrutiny, the government can muster some capital even from the private sector and move on from there.
For lack of any previous historical experiences to draw from, Mr. Subbarao, people often liken this phase to the global financial crisis. If you were to do that, would there be any clear lessons drawn from that period that we must apply at this point, or do you think this is wholly different because it is an external force rather than an internal force that sort of catalyzed into this big financial crisis globally?
No, I think there are some lessons from previous crises which apply even today. Yes, as you have said, and as I have said, and as everyone recognizes, this crisis is different both in terms of its origin and transmission and uncertainty. However, there are lessons to be drawn, like one we discussed even in this conversation about importing lessons or experiences from other countries. We have to learn from them, but we have to adapt them to our own situation. The second thing is to keep your powder dry, not to go overboard. There'll be enormous pressure to do things during a crisis. But governments and central banks, indeed all public agencies, are paid or are in office to apply their cool heads and not to be pressured under the burden of public pressure. So as much as there's enormous pressure to spend, and indeed the government must spend, it's important to look at the medium term, even as we're trying to protect the short term. I do not agree with the view which some economists and analysts have projected that this is an extraordinary situation. You cannot look beyond the next 3-4 months to whatever is absolutely necessary. Of course, we're not all dead in the long term. Some of us are going to be alive. So I think we've got to look at period beyond this crisis as much as we do whatever is necessary at this time.
What's also different about this crisis, Mr. Subbarao, is how it's impacted people at an individual level. There is a report that was out a few days back in the Economic Times talking about how as much as 30,000 crores was withdrawn from the EPFO. We are seeing job losses, of course, but this time in the salaried class as well. And inflation is frankly still a moving target. We're not sure where that one will land. For the individuals, how should this be thought through? How would you have thought it through if you were the Reserve Bank governor at this point?
Well, it's not just the Reserve Bank. It's the government and the Reserve Bank together. Okay, it's not, the burden cannot be put entirely on the Reserve Bank. It's got a limited mandate. It's got limited instrumentality. But yes, people are withdrawing savings, which is in fact one of the problems, that they've run down their savings and they're running them down even more. And if you put money in their hands today, they're likely to save rather than consume. So the way I will look at the situation is that as much as millions of poor households in the country, including salaried class, the low-income salaried class you referred to, they have suffered enormous pain and hardship. Given that the government's resources are limited, I think the immediate priority, as I said earlier, is to use that money where it's going to generate the maximum return and prevent problems from getting bigger. So I would say spend that on restructuring and recapitalization. And another point I want to say, I was thinking as I was speaking to you, which is that, as much as this crisis has been an economic and a humanitarian tragedy, millions of households have suffered, especially the migrant class. I don't want to belittle that. That's a huge tragedy. But having said that, we must also acknowledge that there be no hunger deaths, there be no starvation deaths, which is, I think, a huge plus point. It's a testimonial not just to this government, it's a testimonial to governments over the last 25 years. And it's because of the cumulative effort that a country of 1.3 billion people is today able to talk about food security. So as much as you've talked about people withdrawing their money, we must also look at the brighter side of this.
No, absolutely. I think it's also a testament to federalism, sir, and how state governments have worked very hard to, protect their people and to ensure that they are fed. I know that even as Reserve Bank governor, you tended to look at the sunnier side of things, and that helped in that situation as well. I don't want to end on a pessimistic note. What gives you hope or optimism at this point when you look out into the future?
Well, I apologize if I've been too grim, but I certainly see a bright future for India. I believe that the long-term India growth story is intact. Just notice this, we're a country of 1.3 billion people, per capita income of $2,000, just over $2,000. We have a growth driver that most other countries do not have. That growth driver is consumption. 1.3 billion people with a per capita income of just over $2,000. If you increase their incomes, they're going to spend. That's consumption will translate to production, will translate to jobs, will translate to output, and will come back to more consumption, more investment, more jobs, and we'll get on the virtuous cycle. If you look around the world, there are very few countries that have this advantage. Look at the advanced economies. They're looking at secular stagnation, demographic decline, reduction in productivity rates. So India has this huge growth driver. If we do the right things, we can exploit this growth driver. But we need bold policies, and more importantly, not just policies, but vigorous implementation of structural and governance reforms. Just one example. Today we take pride in how much we moved up on ease of doing business. Indeed, the government deserves a lot of credit for that. But Vietnam, which is about 20 to 25 places behind us in terms of ease of doing business, is attracting more of the supply chains which are moving out of China. So that is a lesson for us about how we can get more investment into our economy so that we can exploit this consumption base. So I would say to end this interview that the India growth story is possible, it's probable, but not inevitable.
Thank you, sir. It's been such a pleasure speaking with you and hearing your thoughts. I know you've been a keen India watcher and believer for many years. Thank you very much for joining in today.
Thank you indeed. Thank you for the interview.
To receive instant updates on all videos from The Wire, click the subscribe button and hit the bell icon. Pay to support independent journalism. Click the link in the description and choose the amount you want to pay.